BlackRock's amended S1 filing for the Bitcoin ETF has left some people confused, and we're going to try to straighten that out for everybody. Welcome back, everyone, and happy holidays. Yeah, it looks like we got quite a few comments, quite a few questions out of the last clip that we did regarding the Bitcoin ETF, and I just wanted to do this quick clip to kind of straighten some of that out, because myself and a fellow Bitcoiner were going back and forth in DMs, and we're all just trying to get clarity, right? Now we start to sound just like the regulators. Oh, sorry. Now we're starting to sound like Coinbase. We're just looking for regularity. Anyways, okay. So let's dive into it. Here is a tweet from James Seifert, who I think he works for Bloomberg. CFA, man at cryptos, asset management at Bloomberg Intelligence. Yeah, exactly. Okay, so here we go. BlackRock's already submitted an updated amended S1, as we know from last week prior to Christmas, for the Bitcoin ETF. And essentially, some of the confusion lies around, okay, well, does Bitcoin actually have to be purchased? Now, as I showed in the last clip, okay, from what I understood that the authorized participants, right, i.e. the investment banks that are going to be able to create, essentially give cash to BlockFi. That's awful. To BlackRock. Okay, they're going to give cash to BlackRock and be able to create shares. And nowhere in that transaction is there any Bitcoin. And this is exactly what I said. The product is, right, these shares of the ETF. Now, granted, we are being told that BlackRock, I keep wanting to say BlockFi, which is really weird. I don't know if that's a predictive slip. Who knows? But anyways, I think that BlackRock, from what I understood, does have to purchase some Bitcoin. But one thing I couldn't find in the document, I couldn't find anything relating to any type of specific percentage that they need to hold in Bitcoin in relation to the number of shares that are being created, because all that's happening is they're receiving cash. That's all. Anyways, all right, so let's dive into this. So I got this nice little tweet here from Eric Balkunas. This makes it super clear the AP, which is the authorized participants, which are the investment banks like Goldman Sachs, JP Morgan, anybody else who wants to create shares of this ETF for their own customers, will not be handling Bitcoin. The authorized participants will deliver only cash to create shares and will receive only cash when redeeming shares. Further, authorized participants will not directly or indirectly purchase, hold, deliver, or receive Bitcoin as part of the creation or redemption process, or otherwise direct the trust or a third party with respect to purchasing, holding, delivering, or receiving Bitcoin as part of the creation or the redemption process. I think that's pretty clear. Now, I also wanted to show, there's this clip from a crypto channel. This is Laura Shin's crypto channel, Unchained. And this is a clip where she has a discussion with James Seifert, and it's about the Bitcoin ETF and the redeeming of shares. Now, the clip is about 3 minutes long. So let's just watch it. I'm going to obviously put a link, to this in the show notes so people can watch, can go and check out the whole entire episode if they want. But I think that this piece is really what's important to us. So here we go.
Participants, think Wall Street traders, these people would gather up Bitcoin. If they're creating shares of the ETF, they would gather up Bitcoin wherever they get it. They would hand it over to the issuer. The authorized participant would hand it over to the issuer. And in return, the issuer would then create new shares of the ETF. They take delivery of that Bitcoin, and those shares would be created to be traded on exchange. So at all times, you're trading Bitcoin for shares of an ETF, which is an in-kind transaction. It's two things that are of equal value. And the IRS does not consider that to be a taxable event. So all of a sudden, you're creating and redeeming shares, and there's no basic transaction happening.
So before we continue, I just want to explain the part of the video that I started it in. James is explaining the difference between an in-kind transaction, and then he's going to explain an in-cash equivalent transaction, okay, which is what the filing was amended to do, okay? So this is what it would be if they had to provide Bitcoin. And then he's going to explain what it will be in real life.
Just that keeps that premium discount at zero. It keeps the NAV in line with the price, and it also is very taxably efficient. With cash create, it's more like, it's basically, that's how mutual funds work in this day and age, right? All mutual funds, for the most part, they pay capital gains at the end of the year. It's very common. ETFs almost never pay capital gains because of that in-kind model. A cash model is where those APs, those market makers, those Wall Street trader type people, they're going to be handing over cash and getting shares of the ETF in return. Or in the opposite of redeeming, they're going to be handing over the shares and getting cash in return. So what that means is that the buying and selling of Bitcoin is happening at the issuer level, which again is how all mutual funds work, right? You give cash and the next day they buy the underlying assets for you. But the problem with that is that's a taxable event, right? So with the mutual fund and with these cash creates, which is not guaranteed that the SEC is not allowing in kind, but that's certainly the tea leaf reading that I'm getting. Obviously, we've seen BlackRock and Grayscale and Fidelity and ARK and a bunch of these other issuers pushing hard to allow in kind because, in my view, it's better for everyone involved for those reasons I just talked about. But the issue with cash create and redeem is essentially it's a taxable event. So, right, that means that at the fund level, they have some sort of gains that they need to distribute. So typically when a fund distributes an income dividend or a company distributes stock, it's taxed as income, which was taxed at like your marginal tax rate. But these cap gains distributions are going to be like, oh, the fund earned like X amount of profit because the Bitcoin that they sold, they have in the fund at a cost basis of 10,000 and they just sold it at 40,000. That's a $30,000 gain, and they have to pay capital gains tax on that, which is 15%, 20%, whatever that value is, which is typically lower than the marginal tax rate. And what that really means is like, if you're holding the fund, you might get hit with a capital gains distribution that you weren't expecting. Now, that's not the end of the world, right? Like if you own this fund and you want to buy and sell it, or if you own Bitcoin and you want to buy and sell it, you're going to be sitting on embedded gains. That's basically what's happening here with these funds. And specifically, it matters to Grayscale because they've been operating for so long.
So that's kind of interesting, isn't it? Right? Isn't it? Because we just got the news today that Barry, right, all of a sudden announced that on January 1st or whatever, right, he's stepping down as the CEO of Grayscale. I'm going to do a clip about that for tomorrow because I got some tinfoil hat take on this and the Grayscale thing with the S1 amendment. So look, all right, so these were my takeaways. Okay, so this Bitcoin ETF is going to trade essentially like a mutual fund, and if you think about it, right, the fund participants, right, like people like BlackRock, for example, the issuers, they wanted to have an in-kind model. Okay, the participants also wanted to have an in-kind model, which would have been more beneficial, but there aren't as many taxes realized from that model. So somehow the invisible hand of I don't know what forcing them to tweak that amendment to make it much more taxable. So yeah, this is turning out to be, very interesting, and we're gonna have to see where this leads. Again, people always wonder, is this good? Is this bad for Bitcoin? Look, this is just financialization. Like I oftentimes, especially in Bitcoin, right, we're super quick to call anything a scam, and I can't disagree with that because I'm one of those people who right away, like I hear some type of yield, I hear some type of you're getting something for nothing, and immediately I'm like, yeah, it's a scam. And I'm not saying that this, is a scam or anything like that, because this is just the way that financial markets work. And they're working, they're essentially doing what they're legally allowed to do. And essentially what's happening is that the model is being changed, right, to benefit the state and not benefit the actual investors. So that's my take anyways. And again, I'm not a financial expert. I could be misunderstanding this entirely. So anybody who knows a little bit better, hey, that's what the comments are for. Help me out, help me, help you, help me. We go around in a circle. Anyways, guys, don't forget to like and subscribe. Help me grow the channel. Help us grow the channel. And of course, if you don't remember, this month's clips are brought to you by fellow Bitcoiner and pleb, Full Throttle Hodl, who reminds you, go fuck yourself, stay sovereign, and I will catch you all tomorrow.